Most people don't get denied funding because they don't qualify. They get denied funding because they choose the wrong funding lane. If you ever felt confused by the difference between banks, CDFIs, business credit cards, or personal loans, I'm going to make this clear in under 10 minutes. Now, there's only 4 funding situations that matter. And once you know which one you're in, your next step becomes obvious. No guesswork, no shame, no fluff. So let's zoom out for a second. Every business funding decision comes down to 2 variables. Do you have a business that's generating income? And how strong is your credit? Everything else, CDFIs, no doc programs, personal loans, business credit card stacking, these are just tools, not categories. The right way to think about funding is simple. First, your business status, then your credit strength. That's how underwriters think, and that's how business owners, you should think too. You don't need a 750 to start. You don't need 3 years of taxes. You don't need to wait until your business is ready. What you need is to find your funding lane and move forward strategically. And here's the cleanest way to do it. Let's walk you through the 4 funding buckets. Bucket 1 is for those who have no LLC or a brand new business. If your credit score is below a 680, you're going to have to provide some documentation to get approvals. Approvals for CDFIs, business credit cards, business lines of credit. With the CDFIs, they're going to offer business loans, business lines of credit. Those require documentation. Some CDFIs allow you with a startup business to use your pay stubs, use your personal income to show that you can actually pay back that loan. Other option, alternative lenders also are going to offer business lines of credit and business loans. Those are going to require things like business bank statements, oftentimes business taxes to get an approval. When you're above 680 with that brand new LLC or with no business at all, you have 2 different options. Let's say you have no business at all. You can do business credit cards using the sole prop method. This is where you apply using your social security number instead of an EIN. And you can get startup capital that way as long as your credit is good. Option number 2, if you had a brand new LLC, you can use your EIN and get access to business credit cards as well. At this level, you're kind of limited to your options out there. You're mainly going to qualify for $75,000 or less in access to capital. With these startups, you can also do SBA loans, microloans, 7A. There's plenty options for startup companies. You're just going to need financials to get it done. Bucket number 2, your business exists, but no real income. If you're below that 680 mark, you're going to have to provide financials again. This is where you come in with your CDFIs. This is where you come in with your SBA loans. This is where you come up with alternative lending options where you have to provide some sort of financials, personal taxes, business taxes, personal pay stubs, personal financial statements, business bank statements, some sort of documentation to actually get that deal done and have the ability to show that you can pay off that business loan that they approve you for, even though the business isn't making consistent revenue, $10,000 a month or more. Now, bucket number 2, again, you can approach it from a no doc funding standpoint. And then also in bucket number 2, if you have a 680 or above credit score, you can still stack massive amounts of capital. You just have to be creative. This is where your business credit cards come into play. Typically, you can get anywhere from $25,000 to $300,000 very quickly as long as your personal credit profile is structured into a manner that lenders actually like. The main indicator for no doc funding is your personal credit card limits. The higher your personal credit card limits are, 20,000. 15,000, 25,000, that's going to translate to the business side and give you the ability to get big business credit approvals without providing financials. Bucket number 2, this is your bridge phase. Credit becomes your greatest asset here. Other options for bucket number 2 is CDFI. This is where you provide your personal documentation, personal income, personal revenue to get approved for loans starting up in bucket number 2. Bucket number 3, my businesses that earn $10,000 a month or more. If you're below a 680, you have tons of options out there that are going to lend you money. Now, sometimes you're going to run into higher interest rates based off of your actual credit scores. I want you guys to understand how credit truly works. Your credit score determines how much your interest rates are on the money that you get approved for. But your credit profile is going to determine if you're approved or not. That's super important for you guys to understand. At this level, bucket number 3, you can qualify for business lines of credit. You could qualify for business loans from CDFIs, from alternative lenders. You can even qualify for funding from traditional banks. As long as you're above that 660-ish threshold, you should have the ability to get a business line of credit, a business loan from your bank. Oftentimes, they'll even approve you for small business credit cards if your credit score is around that 660 range, just to get you rolling. Now, the more revenue that you have in this bucket, lenders are oftentimes at minimum going to give you 1 to 1.5 your monthly revenue. So if you have, let's say, $40,000 a month in income, even if your credit score is low, lenders are typically going to give you at least $40,000 to $65,000 for a business line of credit or business loan with that revenue and bank statements to provide for proof. Now, if your credit scores are greater at a 680, you typically have the ability to stack multiple products and be very strategic, staying with the unsecured lending opportunities. This is going to be your business credit cards. This is going to be your business lines of credit up to certain amounts at a lot of banks. You want to make sure, you want to figure out if the bank is going to hit you with a UCC filing. That's where they put a lien on your business. It's just like how mortgage work, where they're the first lien holder. If you default on your house and you have a mortgage on it, that mortgage company is going to have the first right of refusal to get that house back. Same thing in lending. If they put a UCC filing on your business, they're going to have the first right of refusal to go after your business's assets to liquidate and get their money back. So primarily, one strategy that we implement is really stacking unsecured business credit cards and business lines of credit up to $500,000, where our people, they don't have to provide heavy documentation. We can get this done with like bank statements only and with good credit. Bucket number 3 is super important to note that revenue is not enough. It's very important how that revenue actually shows up on those bank statements. That's going to hold weight. If you're not having consistent daily balances over $5,000, $10,000, $15,000 a month, you're going to struggle getting bigger approvals, because banks are going to look at the amount of money left in that account to determine how much of a loan or line of credit you can be approved for as well. Bucket number 4, this is the best of all worlds here. Strong business credit, strong credit is going to drive you to massive approvals. Now, if you have above a 680 and a business generating 10, 20, 30, majority of you guys anywhere from $10,000 to $100,000 a month with those strong credit scores, that's when the world opens up to you. You can qualify for business credit cards. You can qualify for lines of credit. You can qualify for loans from lenders, banks, CDFIs, literally all the options that are available to you guys. We can also do no doc options, low doc options like 3 months of bank statements and 1 year of taxes, or full doc options where you're able to provide a full financial package and still have the ability to get approved. But what matters here in bucket number 4 is sequencing and doing it wrong. Going after the wrong lenders first can cost you big here. Best standard operating procedure for applications, guys, is to do soft pull lenders first. These are lenders that's going to allow you to get approvals without any hard inquiry altogether. Number 2, you have soft pull pre-qualification lenders. These are lenders that's going to give you the opportunity to know what your interest rates are, what your approvals are up front. Then after you get the hard inquiry, you'll go through final underwriting. Now that you know your lane, don't go at this alone. Allow a seasoned professional who has 5 years in the game, over $129 million in funding at the day of this video and counting, to guide you through your specific lane so you can access and maximize the capital that you're looking for. Check out the links in this video description to book your one-on-one consultation with myself and my team. Peace and love, everybody. Hope this was insightful. Definitely leave your comments below, and I'll catch you on the next video.